Greetings, my forward-thinking financial explorers. Franklin Green here, ready to guide you through another crucial step on your journey to financial freedom. Welcome back to the Money Frog. Today we're diving into a game-changing concept, diversification. Whether you're new to investing or a seasoned pro, diversification is the secret sauce for protecting your investments and maximizing your potential returns. In this video, we'll explore what diversification means, why it's so important, and how you can start applying it to your financial strategy today. Let's hop into it. What is diversification? Diversification is a strategy that spreads your investments across different asset classes, industries, or geographic regions. Think of it as not putting all your eggs in one basket. When one investment underperforms, others in your portfolio can balance it out, reducing overall risk. For example, instead of investing solely in tech stocks, you might also include healthcare, real estate, and bonds to create a balanced portfolio. Why is diversification important? The primary goal of diversification is to manage risk. By spreading your investments, you're less likely to experience significant losses when a single market sector takes a downturn. For instance, during the 2008 financial crisis, portfolios heavily weighted in real estate took massive hits, while diversified ones were better shielded. Diversification ensures your financial future isn't tied to the performance of one specific investment. Another benefit? Smoother growth. Over time, a diversified portfolio tends to grow more steadily than one heavily concentrated in a single area. Types of diversification. Diversification isn't just about buying different stocks. There are multiple ways to spread your risk. Asset class diversification. Spread investments across stocks, bonds, real estate, and commodities. Industry diversification. Invest in different sectors like technology, healthcare, energy, and consumer goods. Geographic diversification. Don't limit yourself to one country. Global investments can protect against local economic downturns. For example, investing in a mix of U.S. stocks, European stocks, and Asian stocks can offer a hedge against country-specific risks. How to diversify on a budget. You don't need millions to create a diversified portfolio. With tools like ETFs, exchange-traded funds, and index funds, you can invest in hundreds of assets with a single purchase. Fractional shares are another great option. They allow you to buy a portion of high-value stocks, so you can diversify without breaking the bank. For example, platforms like Vanguard, Fidelity, or Robinhood let you buy small slices of ETFs that track the S&P 500 or international markets. Franklin's golden tips for successful diversification. Before we wrap up, here are some actionable tips to master diversification. Rebalance regularly. Check your portfolio every 6 to 12 months to ensure it's still aligned with your goals. Avoid over-diversification. Too much diversification can dilute your returns. Find a balance that works for you. Start small, think big. Even a portfolio with just a few ETFs can offer excellent diversification. And there you have it, my friends. Diversification is your financial safety net and one of the most important strategies for long-term success. By spreading your investments wisely, you'll protect yourself from volatility and build a more resilient portfolio. If this video helped you, give it a thumbs up, subscribe to the Money Frog, and share your thoughts in the comments. What's your approach to diversification? Let me know. I'd love to hear from you. Until next time, stay smart, stay diversified, and keep hopping toward financial freedom.